Greetings, members, one and all of the Salivation Nation. The dollar crushes gold and silver. Do we give up? Let's explore! That is the sound of a Federal Reserve note. A brand new, crisp Federal Reserve note, by the way, I might add. I can't really smell it because of this COVID thing, but it is indeed a genuine Federal Reserve note. A $1 bill, you all. Exactly right. This note is legal tender for all debts, public and private. Therefore, we know it is a debt instrument. And you know what happens to debt instruments. Essentially, they lose value, especially when the Federal Reserve on target makes them lose value each year by at least 2%. And as of right now, the facts remain that this dollar bill has lost 7% of its value since last year at this time. And by the way, last year at this time, we saw a silver squeeze movement begin to form. I'm going to talk about that in an upcoming video discussing this because I think it's quite important and relevant today and why we should be not lose heart, not to give up. So that's the message of this video, as the dollar is crushing gold and silver. Let's talk a little bit about it. The precious metals prices have fallen, especially silver, substantially, over 3%. It lost 80 cents as of the recording of this video. It had dropped more than that earlier. But last year at this time, we saw silver rise at about $1 a day for 3 consecutive days because of the silver squeeze movement. But there's other factors we must take into account here too, and that's perspective. Gold has lost about $23.80, well over 1% drop. And even platinum took a little bit of a hit. Palladium, though, is up $53 a day, up over 2%. I posted a video earlier this morning talking about palladium and why it's going up, and the other metals are not. So let's talk about this a little bit more as we reference an article here from Kitco News. Gold and silver pounded by inflation fears and a strong greenback. Well, you would think that gold and silver would rise because of inflation fears. It's a very fickle market here. Psychology rules the day, and sometimes psychology and emotion does not follow logic and common sense. Gold and silver futures prices are sharply lower in midday U.S. trading Thursday. The precious metals are getting hammered following a more hawkish than expected Federal Reserve meeting and some upbeat U.S. economic data, both of which helped push the U.S. dollar index to 1.5-year high today. February gold futures were last down $36.10 at $1,793.50, and March COMEX futures were last down $1.14 at $22.65 an ounce. Jim Wyckoff has been involved in the markets full-time for almost 40 years, and he's seen this many times before. Traders are fickle, especially on a short-term market basis. The gold and silver markets are selling off sharply recently due to a tighter Federal Reserve and other central banks' monetary policies after having been boosted by looser monetary policies for several years. Yet the tighter monetary policies are being implemented mainly due to rising inflation fears. Historically, rising inflation has been bullish for hard assets like precious metals. His bias is that as inflation continues to bite, gold and silver markets will respond overall in a longer-term bullish fashion. And that's the thing. We really can't expect these numbers to move downward in the short term. It's going to be a little bit volatile. But as new inflation numbers come out, especially if they do not react to the coming Fed rate hikes of a quarter point come in March, My guess is that you will see gold and silver pop then, and it'll probably be something that'll be sustainable. In other words, we may not see these lows come March if the CPI numbers come out. Whenever they do come out again near that time, if they don't react positively, in other words, we don't see inflation come into check by that time. Today's U.S. fourth quarter gross domestic product report showed a rise of 6.9% versus expectations for a rise of 5.5%. That's another thing that played a part in this. The closely watched inflation indicator, the personal consumption expenditures, came in at a hot 6.5% annual rate in the fourth quarter. U.S. weekly jobs data was also upbeat. The data helped to rally the U.S. dollar index, which helped to push gold and silver markets lower. And so when you have the global stock markets were mostly lower overnight, U.S. stock indexes are mixed at midday. The marketplace is still jittery Thursday morning following the conclusion of the Federal Reserve Open Market Committee meeting Wednesday afternoon. The FOMC statement did not move markets much. The Fed Chairman Powell's press conference saw Powell seemingly lean more hawkish than expected. Powell gave no specific time frame on upcoming rate increases and said the Fed will be nimble. The marketplace wanted more clarity on timing of the rate hikes and did not get it. In fact, Powell's pressure may have made the Fed's monetary policy even less clear. So it is strange that the metals reacted accordingly, even though there's not really a clear indication of when they're going to be raised. And markets don't like uncertainty. Still, many are thinking Powell will make 5 interest rate increases within the next year. I kind of doubt that. Fed watchers also think the central bank might start to shrink its balance sheet faster than what they had expected. In other words, quantitative tightening. The Fed seems to be in a hurry now, said one analyst. Powell's comment yesterday that the U.S. labor market conditions are consistent with maximum employment means that the central bank is firmly focused on rising inflation. The morning's core personal consumption expenditures number for the fourth quarter appears to corroborate Powell's hawkish comments on Wednesday afternoon. On the front burner of the marketplace is the Russia showdown with Western nations as Russia appears poised to invade Ukraine. NATO allies are sending arms to Ukraine and putting NATO troops on higher alert, including 8,500 U.S. troops. Russia demands on Ukraine and not being able to join NATO have been rejected by the U.S. The situation appears to be deteriorating and will likely get worse before it gets better. And somebody commented on my video when I talked about this with regards to palladium, saying it has hardly any effect on gold and silver, and typically these type of geopolitical events don't. And really, in a sense, they are right, at least in terms of in the short and medium term of the crisis itself. They may pop a little bit here and a little bit there one day when the uncertainty of the event occurs at the outset, but they typically normalize once that news sinks in. So it's hit or miss, and it's hard to tell how geopolitics will play a role. They do, but typically they are, once you get a handle on what that geopolitical event is, in other words, an invasion of Ukraine, which, by the way, is going to be a cakewalk for Russia. Those troops are just going to march right in there with very little resistance and take it over, which means markets probably will normalize very soon after the fact. But it's the unknown. Markets like certainty, and they don't like uncertainty, as this article mentions here. And so it's very interesting to see how it will all play out. But one thing they do, markets, they do gravitate more towards this notion and this idea of wanting things to be rosy and doing great. And so they've taken Powell's statements, as I mentioned, and that along with some relatively stronger economic data with GDP numbers and the like, and the numbers are going to react. The dollar's going to go up dramatically, and gold and silver are going to get smacked down, and that's what's happened. But perspective is everything, folks. Do we give up? No, we do not. Because really, what has been proven itself as a store of value for thousands of years, in spite of a couple of days of lower numbers, that's gold and silver. And by the way, again, understanding perspective of where gold is, especially compared to where it was, is still pushing $1,800, just shy of about $250 from its all-time high. When you're taking that into account, it's not really that far off of base. Silver, on the other hand, took a pretty big hit today, and even yesterday, when we were talking about the potential to see $25 silver was in our sights. Now it's blown the other direction, but it's still solidly above $22. In fact, it's getting close to $23. We were just here not too long ago. And so we're kind of back to kind of where we were with silver. And where is silver now compared to pre-pandemic levels? Up. And maybe not enough to really match the inflation that we've seen during that course, but still, it is something to consider that it is holding its own, and there is some resistance for silver, even though we've seen some dramatic moves in the downturn. What does this mean for us? It means that these are dips, folks. These are dramatic dips, and dramatic enough that if you have the wherewithal, the financial wherewithal to make purchases at as low premiums as possible, it may not be a bad time to do so. In fact, it would be a good time to do so, because most analysts believe that these lower prices are not going to last forever, and we're going to see higher lows, and this is an example of that. Now, obviously, I did not foresee that these prices today would occur. I figured we'd kind of level out and maybe not see much rise in prices for the next couple of days, but to see these prices go lower today is a little bit of a surprise to me. But that just goes to show you that no one can really predict what's going to happen in the markets. So nonetheless, we'll see how it plays out. But there's your news for the day. Interesting indeed to see them get pounded. Do not lose faith. Do not lose hope. And remember, even if these markets make you nervous and you're worried about making a purchase today for fear that they may fall another 3% tomorrow, for silver or gold to drop another 1.5% tomorrow, hang on to the silver and gold you do have. It's okay to get nervous. I mean, it's okay to not buy because you're unsure of where they're going to go. I made a purchase yesterday before this big drop today, and I'm not regretting that move, because I think we're going to see these prices recover. But even if they do continue to fall some, I know that the ounce I bought is going to still remain an ounce. I just paid a little bit more for it yesterday, but that's more than I would have paid the day before yesterday. It's a matter of perspective, and it's a matter of long-term thinking. Looking at the bigger picture here, folks, that's where it's at. This is why we should not panic buy. We should not buy out of fear. We should not buy out of pressure. We should buy out of our own understanding of the markets and spot price and what gold and silver's role is in our lives, and that is to preserve wealth. And so if you keep those things in perspective, I think it'll go a long way, and it'll make things easier as you make buys and time your buys out. It's about smart dollar cost averaging, buying a little bit more when the prices are lower, and buying a little bit less when the prices rise. Or maybe not even buying at all if the prices rise, or if you're uncertain about where the markets are going to go and you don't feel good about a purchase, hang loose and don't buy. I think you're in better shape in these markets these days, especially right now, not buying than making a purchase on a whim and regretting it. You don't want to regret any purchases you make. That's clear. All right, so there you go, folks. Let me know your comments in the section and comment below in the section below. I'd like to extend a multitude of gratitude to you all for taking the time to watch, and to encourage you to please rate, share, comment, and subscribe.